Welcome back to the Cornerstone Private Wealth podcast, Dan. Great to see you.
Great to see you, Brett.
It is December 1st, which means the stock market, and just like your fridge at home, Dan, is probably dealing with leftovers from Thanksgiving. So we'll try to do some turkey analogies, right? But I think like the fridge, right? Some things are probably looking a little bit okay in the stock market. Some things are probably a little bit questionable, and some things are probably completely hands off, right? That you might need gloves to touch. So they even had, I don't know if you saw Saturday, a neat article in the Wall Street Journal. It says, thrifty Americans are testing the limits of leftovers. So talking about how we've had food inflation. Yeah. Now people are probably going to keep things in their fridge for longer.
So what was the takeaway? Is it like a week as the lifespan there?
It depends on the food and depends on how you package stuff in the refrigerator. So I'll share the article with you.
That's pretty interesting.
So today we're going to sort through it all. Things like the Fed's next decision, which is coming fast and furious on December 10th. We're going to talk about some smart year-end tax planning and different strategies to implement with the year-end. And then probably our deep dive segment of the month, we're going to talk about computer trading or algorithmic trading. Specifically, AI again, maybe the role that AI is playing in our trading system. So we're gonna talk about that. By the way, this month we have no slides, but I do have a lot of papers in front of me. So we'll see. Dan, it looks like you're clean on your computer. Although for some reason, when I do this with the papers, I feel a little bit more like an SNL skit, Weekend Update, than I do like Walter Cronkite or Dan Rather or
Well, I'll have to make sure to come up with some jokes to poke fun, but
exactly. We'll take a look at it. So let's set up a little bit of the algorithmic trading. And I have an article in front of me from the Wall Street Journal. This is November 20th. So a couple Thursdays ago, I guess that was the Thursday before Thanksgiving. I had two clients. Thank you, John, for one client. We've been talking about it for seems like 20 years, concerns about computer trading. But it kind of resurfaced again on November 20th. I'll kind of set it up a little bit. And if you recall, that was the day after, I guess, the NVIDIA earnings. They came out on Wednesday. And by all accounts, they were gangbuster. In fact, they're saying for next year, earnings are going to be up like 60%. That's up from a 30% year earlier, right? So what happens after hours, the stock was up like 5%. And then during the day on Thursday, it did kind of an intraday reversal. It ended up finishing, I'm looking at the numbers here, finished down about 3% for the day. So it was about an 8% swing in NVIDIA. The rest of the market followed. I'm looking at a swing in the NASDAQ of about 5%, maybe 4.7%. The Dow was up about 717 points, actually finished the day down 387 points. So this is where the client question came in. He remembered the flash crash back in 2010 when the market did about a 9%, intraday change. And I guess what happened in the news article focused on it in the journal, some traders were saying that traders were using Bitcoin sell-off as a little bit of a lead. So they were using the Bitcoin price that had sold off as a leading indicator on how to sell or to set the computers up to sell securities during that day.
Yeah, it's kind of interesting too. So you can look at Bitcoin over the past year, and generally the trend is pretty close to a match. I mean, there's a high correlation between the price of Bitcoin and the price action with the NASDAQ. But starting around mid-October, we started to see a little bit of a divergence where Bitcoin actually crossed below the NASDAQ trend line. And then as we entered into November, that spread widened dramatically. Right. So, you look at NASDAQ by the end of the month, index is still down in a major way, a handful of a percent or so. But you look at Bitcoin, and Bitcoin closed down, it was close down to 20% over the course of that month. Right. Wow. So you saw that spread really, really widen. And to your point, in this case, it looked like some of the algos were using, this pressure in Bitcoin as kind of a leading indicator and really doubling down on the selling. It was very reminiscent. You mentioned the flash crash back in 2010. Very early on in my career, that was kind of one of those first market events that I lived through. I'll never forget. It was like early afternoonish, and the morning was a pretty unremarkable trading session.
Right.
And then just like that, everyone's screen is all red.
Right.
You look at the chart on that day, it's straight down. And that was the first time, I got my real taste of kind of these algorithmic trading programs where you hit a light pocket, or they call an air pocket of trading activity. And all of a sudden, that momentum builds and it gets out of control really quickly. And I remember at the time, the conversation was about breakers in the market and how do
Right.
we,
And they
you
made some
know,
changes.
and they did make some changes as a consequence of that. So it's one of those things that has been in the background for many, many years now. Your proponents will talk about how it, improves price discovery and levels out volatility. On the flip side, we see these periods where volatility gets really exacerbated, but it's certainly, I think you can see some of the footprints of that and what occurred both with NVIDIA and then earlier in the month with Palantir.
Exactly. So let's go a little bit deeper on it. So that Dan mentioned the flash crash. That's 15 years ago. Hard to believe. That's on May 6th of 2010. Okay. And you're right. In 36 minutes, the Dow Jones Industrial Average lost famously about $1 trillion in market value. It recovered most of it very quickly, but the Dow plunged about 1,000 points intraday and then came right back up. So that was really scary. So that, I think that shows you, for 15 years, it's been going on for a while. There's
Mhm.
firms like Citadel Securities, a famous hedge fund, Renaissance Capital, or trading firm. They hire a lot of quant traders, like PhD computer science people, not necessarily just financial people,
Yep.
but a lot of PhD computer science people to pick up these trading things. So I looked up some stats. It really started, if you look at 2003, after the .com thing was sorted out. Algo traders accounted for about 15% of market value. Okay, and then by 2010, when the flash crash came, they accounted for about 70% of equity trading. Then there were some buffers put in. But when you go through the research over the weekend, it could be as high as 80%. I don't know what you're seeing as far as the trading volume that are on what we'll call autopilot through computer trading.
No, I think your figures are kind of spot on, and it's very interesting too because even within the algorithmic trading, there's different types that these various firms are employing. Whether it's momentum trading or they're looking for particular price points or volatility
Right.
measures. Historically, we've seen a lot that are tied to the VIX. So the long story short on that is that when it hits it's violent.
Right.
It's not like a normal trader where you might ease into a position or you might gradually wind down. It's like a light switch. And we also saw during the course of the month we had some issues with CME futures,
On
which kind of
Friday, yeah.
added to that volatility, that thin volume, which exacerbates these algo trades. So it was really spectacular.
But, some of the trades, I think, because it seems that other traders are mimicking some of these tells. If they're
Hmm.
all looking at Bitcoin, it can have a way of exasperating
Oh
or
yeah.
magnifying trades, because if they're looking at a lot of the same things, and you see that sometimes in technical analysis when you have an oversold or overbought condition. So that's if they're using the similar tells, that could be a concern.
Absolutely, and the algos that are all working on these similar things, it starts to create kind of a self-fulfilling prophecy and a little bit of an echo chamber there. So you're right. It's just the viciousness of the moves is so exacerbated by the fact that you have these dispassionate algorithms going through and saying, okay, we hit our levels,
Right.
flip the switch.
Right. And so, but AI, they're using AI for other things too. I was talking to somebody recently who has been using AI to read over financial reports, very
Mhm.
large documents. In our research, we found that, pouring over things like Federal Reserve minutes, that could take, traders and researchers hours to figure out key statements. Very easy to dump that into AI, and it kind of gives you you can interpret the Fed speak in a much easier way.
Yeah, it's an excellent productivity tool in that way. One of the things you just have to be careful with generally is even when you're putting in a document that's a fact-based document or a set of minutes, you really have to go through on all of these AI summations and go through
Right.
and kind of double check them, right? So
Right.
it ends up you get some they call them hallucinations, and it might move factors or figures around. It's for the most part, it's phenomenal, but you do have to worry about that. Then the worry becomes, okay, if you're using AI as your expedited research department, and then you're making, you're adjusting your algorithm based on this new data.
Right.
It's like anything, garbage in, garbage out. If you're not fact checking that, all of a sudden you can get a really perverse outcome in the markets, and it happens at light speed rather than the old days where we're running tickets across the trading floor.
So let's talk about the positive aspects and the negative aspects. I have a list of
Sure.
widely documented positives, widely documented negatives. My interpretation right up front is that I would think from a client standpoint, I do when we do the research here, I would think that I think they cancel them out. They kind of cancel each other out because that same sell off, flash crash could occur, and it has saved us a little bit when we've gone through corrections. Perhaps some research would say maybe we're not going to have as big of a corrections. We saw that in April. When you get to certain, support levels, you get the computer buy-ins as well, right?
Absolutely.
It's
And
not just all selling.
I think one of the things that would be interesting, and I haven't done the research myself, but it's this conversation spurring me into it. But I'd be curious, as the advent of algorithmic trading has taken off, to take a look at recovery types and
Right.
how those have changed over time, because it feels more and more these days that we have this pattern of V-shaped recoveries
Hmm.
where you're hitting that definitive floor and then, it's all risk on. Yeah, as opposed to maybe, the longer drawn out recoveries we'd seen in the past. I wonder how much of that could be attributed back to just algorithmic trading
Or if it could
patterns.
be quicker, yeah. If the whole correction of bear markets historically are a lot shorter than bull markets. So perhaps they would even be shorter. So
Shorter.
some of the positive aspects are we enhanced efficiency and speed.
Yep.
Obviously, you can just do a lot more trades, right? Quickly. Feel free to expand on any of these. Reduced emotional bias. AI systems make decisions, purely on data. So you have that part could be some positives of taking the human element or human emotions out of it. Superior pattern recognition.
Hmm.
Obviously, these machine learnings can identify these complex patterns. Improve risk management. You could do that too. You can set, the same way you could do these buys, you can set some protection limits in
Certainly.
for various prices. That might help a fund or even an ETF improve risk management. Then increase liquidity and price discoveries. These are the major. Anything you think I'm missing
Well,
as far
also
as the
just in a
positives?
in a normal day of trading, they most certainly improve liquidity, right?
Right,
Right. So
right.
that's a big one. But your counterpoints to that are you're going to see sharper intraday moves. You're going to
Hmm.
see much faster momentum reversals in the market. And as we hit on before, you're going to see more of that herding type behavior, right? Algos copying other algos. You've got similar thesis, and all of a sudden, um, you really see these moves get exacerbated.
Yep, that seems to be the biggest negative you can come up with. We'll call it like just increased market volatility, right?
Yeah.
Where they amplify the market swings. That seems to be the negative. Then the same way risk is a positive, it's also risk is listed as a negative
Yeah.
too, right? Because there's some concentration risk if a lot of them are following the same models.
Yeah. So I think when you take it on balance, it probably ends up being, a neutral to slightly negative overall for the market in my estimation,
Yeah.
just because of the increased volatility. And then, I always try and think and take it back to our clients and think about, investor behavior. Just the nature of the markets now and how quickly they move, I think can, kind of tee clients up to make mistakes
Right.
and be overly emotional. Um, and that's also just a consequence of general data sharing, the
Absolutely.
fact that clients have access to portfolio value at all times, and, the intraday moves in the market.
So I think, Dan, that lack of transparency, not knowing what the black box trading algorithms are for clients is a little bit concerning, so
Yeah.
I hear makes people nervous.
Absolutely. It was much easier when everything was on the exchanges and you didn't have these dark pools of money. But, um, what we talked about with the trade-off with efficiency and better price discovery, it's,
Right.
at least in theory, it's a better outcome for clients.
Yeah, and the last two negatives with AI trading are interrelated: vulnerability to errors and manipulation, which really comes down to a lack of human judgment. In fact, I think the flash trading, there was somebody prosecuted for that. There was some real manipulation going on there. So but same way, the regulators have these tools as well. So I think they can pick up on stuff like that. So in closing out, I think the bottom line is it is AI trading, algorithmic trading is probably here to stay. So we're probably going to have to live with it because it's not going away. The good thing is it's the same as our general advice, which is we've shown those charts many times before, where if you miss the top 10 trading days or the best trading days of a decade or a year, you sacrifice most of the return. So we have to tough these periods out that are flash crashes, and if you where you get caught is if you try to trade into those things.
Yeah, time in the market versus timing the market.
Right, exactly. So, but all that being said, we had a little bit of a, back to the future, thinking about the flash crash, and we did have a very volatile month of November. In fact, the first 2 weeks were very negative, and then really last week of trading, we had a nice reversal, and we basically eked out a gain. I'm looking at the numbers here. The S&P finished the month up 0.1%. So it did extend technically the streak to 7 months. By the way, we looked at research that shows when you have 7 months, it hasn't happened since 2018, you tend to have another positive month. So we'll see if we have that eighth month.
Well,
in a
let's
row.
hope our December trading action is better than 2018.
Exactly.
Right.
That was a bad one. Right.
That was the Santa Claus rally that didn't come, but it was interesting too. I mean, you mentioned the S&P and the Dow were able to basically eke out a gain. The NASDAQ on the flip side snapped their 7-month winning streak.
That's
So
right. Down 1.5% for the month of
yeah.
November.
So it was and really it would have been, probably closer to a 1.8% loss in that neighborhood if we didn't have such a strong Thanksgiving trading week.
Interesting too that if you would have gone back to last month's podcast, and if I told you that Nvidia, which is the largest market cap, was going to be down 12% for the month of November, you would think the Nasdaq would have been down a lot more.
Yeah.
Some of that, and I know you follow it very closely, but some of that was talk a little bit about the to put you on the spot, the Google versus Nvidia trade that we saw happening over the
Yeah,
last
so
few
it
days.
was interesting. I mean, for clients that have been following along with AI and following along with the podcasts, you're familiar at this point with ChatGPT and OpenAI, right? The company that produces ChatGPT.
Right.
And really for, the past handful of years since GPT-1 came out on the scene,
Hmm.
ChatGPT has been the dominant large language model, the AI model
Right.
and everyone's been playing catch up. We had a little bit of a scare earlier in the year when we had DeepSeek that came out of China, where everyone thought, oh, wow, they caught up very quickly to ChatGPT. Well, we ended up seeing that maybe that wasn't as much the case. However, Google has been quietly working behind the scenes and not so quietly on their Gemini model. And they've always been playing catch up to ChatGPT. And this
Right.
is the first time where the Gemini model has surpassed ChatGPT. And so much so that Sam Altman has acknowledged it. I mean, there was a leaked internal
Right.
memo where, he basically gave the all hands on deck to the OpenAI employees that, morale's not going to be good for a while. We got to play catch up. We're in a good position to do so. But that was very unexpected. So what you started seeing as the trading went on throughout the month was that, that OpenAI NVIDIA ecosystem, right? So you've got your Microsoft, your Oracles, and NVIDIA, et cetera, are all playing in one bucket, your Meta. And then on the flip side, you've got your Google ecosystem. They're talking about creating their own chips. Their LLM model is great.
Hmm.
So you started to see that while there was a general sell-off in AI-related names, that you had two camps where the pain was not evenly felt.
Right.
So that's an interesting development. Now, the flip side for all of them is that still the big limiting factor, whether you're in the NVIDIA camp or the Google camp, is power supply in the US is still woefully under where it needs to be to continue this expansion. So that's that limiting factor that I think you're going to see as
Hmm.
we continue to have challenges moving forward.
No doubt we'll be talking about that. Other big news, I think, for the month, small cap outperformed again. In fact, I can't believe this. And they are outperforming slightly year to date, but through April, through the April lows with the tariff tantrum, do you know the small cap has outperformed the S&P every month? It was pretty close in September, so I heard that stat. I'm surprised about that, but small caps did outperform. So going into next year, if the Fed does cut rates a couple of times, don't sleep on small caps and internationals. We're going to widely reported at the end of this year, if everything holds the way it is in December, we're going to be talking about the first year in a while that international stocks actually outperform the U.S.
Which is, it's great. I mean, as somebody that's been sitting for the past handful of years and talking about portfolio
Right.
diversification and why the U.S. is phenomenal and our dynamism is unmatched, but you've got to find other pools of and other areas, geographies to allocate capital to. It's nice that finally that is playing out, and we're kind of reverting to that historical, spreading your risk and getting some return out of other parts of the world. So,
And bonds quietly are having a
yep.
strong year. You look at the ag, the Bloomberg Ag for a proxy for the bond market is up about 7% year to date. So that's a very strong year for bonds. And let's shift gears. And by the way, I should have mentioned we're not in the studio today. We're in our conference room in Northfield. So hopefully our makeshift studio is coming through okay. We'll see how it works on the podcast. All right.
Exactly.
So let's switch segment. Let's talk briefly about the Federal Reserve. I think their meeting is on December 9th and 10th. So we're expected to. What's the latest? I know you've been monitoring on a daily basis the probability
Yeah.
of a cut.
So we're up to 87.6% likelihood of another
Mhm.
25 basis point cut. And really, I mean, that number has evolved pretty dramatically. If you go back and put us a month out, that number was at about 63%.
I remember.
And that was a
Sure.
real contributor to the volatility throughout the month of November.
Right.
I know we always focus on AI, and if you're familiar with the picture of Atlas holding up the world,
Yeah.
it's like NVIDIA holding up the global economy. But right alongside that set of risk was, hey, the Fed, it might stand pat. We were with the government shutdown, we weren't getting a lot of the data that we're normally privy to. So we didn't have CPI or CPE data, some of the employment statistics. So it was, it started to seem like, hey, maybe the most prudent course would just be to sit tight.
Right.
Seems like, now that trend is reversed, and it looks like we're moving in the direction of an additional cut.
And reports over the weekend, it looks like Trump's saying he's going to nominate somebody potentially before Christmas. The word's out that it's Kevin Hassett. I read a report over the weekend that said if one economist was saying that if Hassett were to take over the Fed, that might be 75 basis points in additional. So 3 additional cuts over what normally may have transpired. So that's quite a cut.
And you think about that in addition to, so a more dovish policy from a rate setting standpoint, and they're also doing they're ending their quantitative tightening kind of regime. You could have a serious liquidity boost into the marketplace.
Right, exactly. So we'll see the Fed. So we're going to be on Fed watch. I don't know if you have the numbers for January, as far as what the probabilities are. If not, we can cover that on January's podcast. Actually, the way the market's going now, that's almost an eternity away to figure out what's going on with January.
Yeah, I'm just looking from the 350 to 375. The probability right now is low, but we're so far out. It's interesting.
It was like 22% or something.
Yeah,
last I looked at
so
it.
it's not.
Yeah, we'll see if that's on the board. So let's move to the final segment, just year end, because we are in December. So a couple things to consider for taxes. We always talk to clients about tax loss harvesting. As a reminder, we could talk about that. It's tough this year because we don't have a lot of losses. But what you're able to do with tax loss harvesting before the end of December is we can look through your portfolio, and if you have something that's been even temporarily down, for example, the last couple of years for clients, we've been using bond funds. If we have a bond ETF, for example, that you clip 5% coupon on, but maybe the actual price is down in value, we can sell the one ETF, buy another similar ETF, take that tax loss and apply that towards your gains. So that's something to look through your portfolio. We've looked through most of the client portfolios. For the last couple of years, we've had tax losses. 2022, we had a lot. this year it's kind of good news that we don't have them, but we're looking
Yeah.
through those.
And, also too, it's been one of those years where, kind of it really did pay to be a buy and hold investor throughout all this volatility. So, on the flip side, it's not as if we've been taking a ton of gains in the portfolios either.
Right.
So to the extent that we have them to offset, there's still some names that have definitely underperformed in sectors that have not risen to the same extent as, as technology and some of the telecom names. But yeah, it's good to look, and certainly that's a conversation we have with our clients, with their accountants, just to kind of see what sort of budgets we have to work with there. One of the other things, the end of the year, for those of you that have not already taken your full RMDs, it's a good time, obviously, to get that taken care of, and also consider making some qualified charitable contributions, or
Right.
excuse me, distributions. So another way just to kind of limit some of that income going into the end of the year, and potentially be helpful from a tax standpoint.
Yeah, and this year's going to be particularly interesting because we did pass the one big beautiful bill, which
Okay.
extended the tax bracket. So let's talk about some of the changes there. I have a list in front of me. First of all, from an estate tax standpoint, we were set to the thought was earlier in the year, if that didn't get approved. By the way, the bill got approved on July 4th. Right. So, but what we had is estate tax exemption was going to be reduced down to about 7 million. And now in 2026, we're going to be up at 15 million. So that's going to be an all-time high. So for married couples, their exemption amount would be 30 million. So that covers a lot
Yeah,
of
I
people.
would say for most investors, that probably gives them ample wiggle room.
Right, exactly. And then a lot of people in New Jersey, we have a lot of clients who are sitting in New Jersey today. We have offices in Northfield, New Jersey, Center City, Philadelphia, and Radnor, PA. But for the New Jersey clients, helpful to have a higher SALT limit if you can use it. So we're going to go, and that's 2025. So that's this year. You can go up to 40,000 from 10,000. Okay. So, but there's a cap on that for joint filers who earn 500,000 or less. So it's pretty helpful. There is going to be an interesting, I haven't read a lot about it, but we're going to have now a cap on charitable deductions. So for people that, and definitely, by the way, the caveat is please talk to your accountant on that. We can't give you full tax advice. So we will happy to talk to your accountant for you if this applies to you. But there's a kind of a little bit of a floor on charitable deductions. So you can only take charitable deductions if the deductions exceed 0.5% of your adjusted gross income. Okay.
Yeah.
And then there's a new 35% cap on the value of your deduction. So I guess I think of it this way: if you're in a 37% tax bracket, you will no longer get the benefits valued at 37 cents on the dollar because of these changes. Because your cap would
Yeah,
be
I mean, it seems
35.
like, between the increases to the standard deduction and some of these limitations on itemizing, they're really continuing the trend of pushing most families into the standard deduction.
Right, exactly. So, but a strategy there would be from a tax standpoint. You could add money to a donor advised fund this year and kind of still reduce your income. So that's a viable
That's
strategy.
viable. And we said, again, especially for the tri-state area type residents where they have high property tax burdens, looking at qualified charitable distributions to keep yourselves under that adjusted gross income limit. Other year-end conversation points, just to think about, also gifting, Roth conversions,
Right.
some of these big items that, again, depending on your facts and circumstances during the course of the year, they may or may not make sense. But, these are part of the ongoing conversations that we're having with clients.
Such a good point with gifting. It came up a couple times this year as our clients, as we update their financial plan, especially with the gains over the last couple of years. We've had that conversation with clients. Basically, it's something like, who's really going to spend your money? And so what you're able to do for children and grandchildren, you can gift up to $19,000 each. So a married couple can do $38,000 this year and next year to be able to reduce, remove that from your estate. There's no gift tax filing if you stay below that amount. So that's helpful.
Yeah, and just one of the other items too, just some housekeeping for our clients that are engaged with multiple advisors. just make sure you're reaching out to everyone across all your custodians, making sure you're taking your RMDs between now and the end of the year. It can get a little complex. If you have an old 401k sitting out there that you haven't consolidated, you've got a separate RMD requirement there for any employer plans. So, you just want to be keeping tabs on that. And again, we have time, but, with the holidays quickly approaching, that time disappears quickly. Some other just housekeeping items, thinking about, we had a very tech heavy year from a performance
You bet.
standpoint. So really reevaluating, where tech is in relation to your overall portfolio. Is it still an appropriate amount? Has that gotten a little bit out of hand? Just things to think about in terms of risk levels, liquidity for 2026 obligations. So,
Right.
again, we want to make sure we have that bucket of income going into next year. Gives us some flexibility if the markets don't behave, that,
Mhm.
we're not reaching to sell equities. And then just general allocations. I know we talk about it almost on every podcast, but it's always a good time at the end of the year to sit down, look at things, and make sure that our balance is still intact.
Absolutely. Yeah. Tell people if you started with a 65-35 portfolio at the end
Yeah.
of 2022, right? So you're going to have a lot more in equities at this
Mm.
point. Just a couple other smaller things, just kind of fun reported stuff. We know tips and overtime. People are hearing about that. So that happens. Taxpayers um, can deduct up to 25,000 in tips and then 12.5 in overtime income for single and 25,000 for joint filers. So that perk starts to taper a bit. It looks like if you have income over 300,000 for married and 150,000 for single. So that was widely reported. No tips, no tax on tips and overtime. Car purchase, you can get a deduction up to 10,000 on loan interest for U.S. assembled vehicles for personal use. So that also has a cap to 200 for married, 100 for single, 150 to for single. Seniors, this is I think this is a good one for taxpayers who turn 65 this year or older. There's a new senior deduction up to 6,000 for single and 12,000 for married couples. So that's something, and that phases out at 150,000 for joint filers and 75,000 for single filers. So that's something we'll see clients.
So you're telling me turn 65 and buy a Ford.
Right. Exactly. Yeah, now you're double dipping on that, right? So, which is great. So I think that's there's some others in the big beautiful bill, but I think that's a good kind of comprehensive list. But the bottom line is, I always say December is a good time to update your financial plan, and January is also a good time.
Yeah.
But what we're seeing is I think we do have a little bit of the wind at our back for December. December's, if you look at the Stock Traders Almanac, it's since 1950. It's the third best month of the year. The average return's about 1%, so that's a positive. So we have a little bit of a wind at our back. And if you combine that on years where the Fed's lowering rates, it's even a little bit of a better story.
Well, and I agree with that. And I think the consumer, one of the big drivers of December being a good month is the consumer strength.
Absolutely.
And we just saw with Black Friday sales, whether it's overall sales or just internet exclusive, very strong set of sales historically. So I think for now, we still are in that position where consumers strong, the Fed's being accommodative. The markets, have some good underlying momentum to them. So hoping that we continue this throughout the end of the year.
Yeah, and the consumer, as a reminder to the clients out there, consumer is a big part of it. Still 70% plus of the economy. So I don't know how many times for clients this month we'll use the term Santa Claus rally, but we'll see. But I can tell you in previous years where you think the consumer is dealing with bouts of inflation, in the U.S., they do spend for Christmas. They spend even if they don't have the money. Because what you'll see is a high correlation with big credit card balances in January. So expect. I think that was a good tell last week that Black Friday was, and today we're time stamping this. We're on December 1st, so this is Cyber Monday, right?
Cyber Monday. You got any big purchases lined up?
I don't think so, not for me, but tomorrow we are traveling, so isn't tomorrow Travel Tuesday?
Travel
I'm
Tuesday.
not sure what Wednesday will be, but it's gotta be it's gotta be something. I don't plan on purchasing anything
It's
today.
Travel
Yeah.
Tuesday, Unwind Wednesday, and then Thursday, Friday working days for us. So it'll be a abbreviated week, but
Yeah, and we're
please
headed
reach
out
out.
to, our national conference for, and holiday, celebration for Concurrent. So Concurrent, for the clients out there, they might see, mail from Concurrent. They can kinda do our back office operations. We're partners with Concurrent, so we're taking the whole team out to San Diego in a couple days. We'll share it next month, what we kinda learned at that conference.
Absolutely.
So I wish everybody a great holiday season. It's been a great year. There's a lot to be grateful for in 2025. Thank you for your confidence in us all year, and we look forward to communicating during the month of December and January.
Well said, Brett. And thanks everyone for your confidence. I know this was a year of transition for our firm and for many of you as a consequence. And we're just excited you were along with the ride. And we can't wait to continue to grow and serve you guys every day in 2026.
Look forward to big things in 2026. Thank you all.
Yep. Take care.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors LLC, an SEC-registered investment advisor. Concurrent Investment Partners LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor a recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.